Good day, young Padawans. Welcome back to the channel. In today's video, we'll be breaking down the week 3 candle range for the month of July. I will walk through the higher time frame narrative, the liquidity behind the objective that shaped price delivery, and how the market presented high probability trading opportunity throughout the week. Before we focus on the week 3, let's briefly review the previous week price action. Understanding the preceding order flow is essential because every trading decision begins with context. Once we establish the context, we will refine our analysis to the daily, 4-hour, 1-hour, and finally 15 minutes time frame to identify precise execution model. Starting with the weekly perspective, week 1 developed a balanced range. Here is week 1 as it developed a balanced range. Week 2 then manipulated the high of our week 1 before closing within it, confirming that the range remained respected. From that observation, my liquidity objective became very clear. The first draw on liquidity was the week 2's low, which is this one right here, followed by the week 1's low. At that time, I anticipated the fair value gap created during the previous expansion would eventually be rebalanced. Those expectations formed the foundation of my bearish outlook going into week 3, which is this candle range we are to talk about right now. Now let's refine the analysis on the daily time frame. Our objective here on the daily time frame isn't to analyze every detail of the previous week, but to understand how each trading day contributed to the overall weekly narrative. Monday, right here, Tuesday, Wednesday, Thursday, and Friday together form the complete week 3 candle range. Rather than viewing these days independently, I prefer to see them as components of a larger institutional delivery. Beginning with Monday's price action. Right here on the Monday's price action, Monday produced the initial bearish distribution. Tuesday confirmed the bearish order flow with another high probability setup. Wednesday entered consolidation, allowing the market to rebalance before Thursday delivered the primary bearish expansion. Finally, Friday remained relatively balanced. Right here on Friday, price remained relatively balanced, closing back the week in consolidation after the major draw on liquidity objective had already been achieved. Now let's move to the 4-hour time frame. Refining the analysis on the 4-hour time frame, the execution model became much clearer. Throughout this week, the market remained and maintained a bearish order flow. Each trading session respected the 159, as I will walk you through just in a while, delivering opportunities through the 159 sequence. On Monday, right here on Monday, the Asian session established the initial accumulation. The 1 o'clock candle delivered the manipulation, sweeping liquidity while reacting from a predefined key level. This was our key level. The 5 o'clock candle initiated distribution, and the 9 o'clock candle continued the bearish delivery towards draw on liquidity. This completed the 159 sequence and produced the first high probability setup of the week. Now moving to this Tuesday's price action, still on the 4-hour time frame. Tuesday respected Monday's 4-hour CRT candle range, which was our same Asian range low. Observe this zone carefully. Tuesday respected this low, and which was used as my key level for this expansion lower, for the bearish expansion lower. That level became the foundation of another bearish expansion. Once again, the market produced a clean 159 sequence. The Asian session formed accumulation. The 1 o'clock candle manipulated liquidity. The 5 o'clock candle distributed massively into drawn liquidity, and price later transitioned into consolidation after the objective had been achieved. So observe this zone carefully. The Asian range was swept around the 1 o'clock AM candle range. 5 distributed massively, then 9 consolidation due to our drawn liquidity had already been achieved. Now moving to the Wednesday's price action, still on the 4-hour time frame. Here on the Wednesday's price action, Wednesday was primarily a consolidation day. However, within consolidation, liquidity continued to be delivered according to the higher time frame objective. The market first swept Asian range. Here on our Wednesday's price action, the market first swept Asian range high before distributing towards Tuesday's low, completing the remaining bearish objective. Once that objective was fulfilled, price naturally transitioned into consolidation and reversal. So, re-explaining this, the Wednesday's price action, this was our Asian range, our consolidation. This candle right here was our Asian range consolidation, and market took its high at a key time, which we are going to look into on the 1 hour time frame. Then distribution lower, taking this liquidity out first, and then our Tuesday's low as second. Moving to the Thursday's price action. Thursday differed slightly from the previous session, and something happened on the Thursday's price action. Although it maintained bearish continuation, it didn't produce a 159 sequence because the Asian high session remained intact. Instead, the market simply continued distributing towards existing drawn liquidity. This variation highlights an important principle. Not every trading day must display an identical execution model. The higher time frame narrative always takes precedence. So what does this actually mean? It means that right here, our Asian range was the actual one that manipulated this range high right here, and it was also a key time high, our 9 o'clock's high on our Wednesday's price action, and distribution happened immediately here on the 1, 5 and 9. So all this 159 was all distribution. Since manipulation has already occurred, taking out a key times high, then we should be anticipating distribution immediately. By Friday, the week, moving to this Friday price action, the majority of the weekly liquidity objective had already been achieved. As a result, markets transitioned into rebalanced and traded within a relatively narrow range before the weekly close. So Friday didn't actually offer a classic sell nor a classic buy, but was actually was a buy. Was a sell though, because liquidity has already been taken here. So I'm still anticipating Friday to take out this Thursday low. Now let's refine the executions further by moving to the 1 hour time frame. This is where times becomes critical. One observation I repeatedly document is the significance of the 3 a.m. key time. Monday's high, which is this right here. Let's observe this zone carefully. Monday's high was established precisely during this window, and importantly, that high formed above the daily open. We should be very sensitive about this daily opening price. That alignment between time and price and higher time frame context produced the order block that later became our execution reference. But right here on the 1 hour time frame, the order block isn't very clear. So let's move to the 15-minute time frame for a clearer understanding. This is our 15 minutes order block. Here on the 15 minutes time frame, we had a clear order block, and I'm marking it out right here on the 15-minute time frame. We had a clear order block which supported our bearish execution. This order block sponsored our bearish execution, and remember, where should our drawn liquidity be? Around this zone. So on Monday, if we are to carefully observe the market and execute, we should have profit of this Monday's move, taking our entry from the open of the order block or the midpoint of the order block, depending on what you really want to capitalize on. Right here, and your stop loss will be the high of our 15-minute order block, since we have already confirmed that the high of the day has already been formed, and our target should be this drawn liquidity right here. And you target 4 RR. That's not bad to start the week with. We target 4 RR immediately. Now let's move back to the 1 hour time frame for the Tuesday, Wednesday, Thursday and Friday's price action. Here on the 1 hour time frame, remember clearly we said on our 4 hour time frame that our 4 hour CRT candle range low was the one that supported this Tuesday's price action, and Tuesday really offered a clean 1 hour order block, which is this right here. This is our Tuesday's order block. And price offered a clean price action right there, creating its high around 3 o'clock key time. So right here on Tuesday, from the open of the order block to the high of our order block, 10 pip stop loss to target Monday's low. Tuesday didn't actually give a nice RR, but if we are to look much deeper, our drawn liquidity is still low. If you remembered from the first 3 to 2 minutes of this video, I said something on the weekly time frame that our drawn liquidity first will be our week 2 slow, and our next drawn liquidity will be our week 1 slow, which will be our final drawn liquidity. So Tuesday you can actually target 5 to 6 hours, and it delivered. So Tuesday offered a nice and classic sell. Moving to the Wednesday's price action, remember our execution should be above the open if we are selling, and below the open if we are buying. Moving to the Wednesday's price action, do we have a key level right here on the Wednesday's price action? Yeah, we have a key level. High of the day formed around 3, liquidity swept, taking our Asian high right here. So Wednesday's price action, since it's a range, it offered a key time entry. For experienced traders, they will take their entry from here, from that liquidity sweep right here, and this tells us that even in a ranging market we can still spot some trading opportunities. And to target, remember we are to target our Tuesday's low, which is this right here, 6R also on Wednesday, if we are very observant on what price is actually given. So 5R on Wednesday's price action, even in a ranging condition, we still found an entry. And the high of our Wednesday's price action was 3 o'clock, again key time. So Thursday was a little bit, Thursday's price action was a little bit confusing, because here comes the variation highlight, and here comes an important principle that not every trading day must display an identical entry model. The higher time frame narrative always take precedence. So here on Thursday, immediately Asian high was taken out around the opening time, which is our 00 o'clock, markets distributed, but it gave us an entry only if we are very observant at 1 o'clock. Okay, at 2 o'clock. As you can see the annotation here clearly. At 2 o'clock, we had a classic entry into above the opening price, and we are to target Wednesday's low or our weekly low, CRT low. Sorry. Right here, and our stop loss should be here, 4 pip stop loss, and our Wednesday's low first as our first entry, offering 7RR, and we may anticipate for the weekly's low, which is this right here, our week one's low. Yeah, this right here. So when Thursday's price action offered a 14RR, starting with a 7RR right here to a 14RR. That is for the Thursday's price action. And Friday just offered a random range, which that will be an assignment for you. Go to the chart and study Friday's price action. I've given you an example from Monday, Tuesday, Wednesday, and Thursday's price action. So this week was actually a lot of loss. I took a loss on Monday, Tuesday, Wednesday because I wasn't understanding the price action very well. Since we took close a little bit above week one's high, I thought it was we were still in a bullish momentum. Sorry, I thought we were still in a bullish momentum. So I took some loss in this week, and wishing you all good luck, good trading. Hope you found something insightful in this video, and we all gonna win.